TCS is likely to report a growth in its top line due to a large deal win. Margins too are likely to see an expansion on a sequential basis. Agam is here to take us through first what the street is pricing in for TCS. Good morning, Agam. More of the same?
Yeah, absolutely more of the same. No fireworks expected. Relatively steady, quarter to come through, and this is of course provided that we consider that this is a quarter which has been laid out because of furloughs from clients, and that may impact the earnings. In terms of the dollar revenue growth, we're likely to see an uptick around 1.5%. This is of course according to the BloombergQuint poll. But as far as your Bloomberg estimates go, that is a consensus. In rupee terms, you're expecting about a 2.2% growth. Your EBIT could rise by around 4.3%, which is why margins could likely see about a 50 basis points expansion to around 24.5%. And net profits are expected to rise around nearly 2% on a sequential basis. Now, among the factors that will come into play is, of course, the mega deal that they signed with Phoenix Group. And that is something that will come into play and aid the top line. Besides that, we're looking at total contract wins, which are estimated to be at around $2 billion. Not the highest that TCS has seen, but a strong number all the same. So we must consider that, and that will be a part of what the top line may be part of. Of course, there will be a little bit of slowdown as far as the BFS and the retail segment is concerned. But that said, again, it's a relatively small quarter because of furloughs, as I've already mentioned. Margins are expected to expand on account of weaker rupee, as well as lower selling and general and administration expenses. All in all, it may very well be a very steady quarter. We are watching out for, however, BFS as well as retail and the kind of demand that we have seen out there. We're also keeping in a track on client budgets. Gartner has already suggested that we are expecting a relatively stronger 2020 in terms of client spending. So naturally, we will start getting trends as far as TCS is concerned, and their clients and the kind of spending they are coming along with. And of course, outsourcing deals, given the kind of volatility that we can expect, given it is a presidential election year. But it will be a steady quarter all the same.
Okay, so steady quarter for TCS. The other IT major, of course, is HCL Technologies. Again, remember, viewers, post-market hours today. But HCL is likely to maintain the growth momentum on account of IBM products acquisition. Agam, what about this one? The conversation at the start of the month was that out of the top four, HCL might show the strongest growth. At least one of the analysts told me so. Is that indeed the case as per the consensus?
Oh yeah, I mean, it's evident in the guidance numbers itself. There's such strong guidance, and they've upped their guidance as well in the previous quarter. So when in terms of expectations, again, in rupee terms, likely to see a 2.6% uptick. Revenue growth likely to see about 3.6% growth. And these are relatively smaller growth numbers as compared to what we have been used to. And again, this is a seasonably smaller quarter. And we're likely to see a little bit of contraction in EBIT margins, but on the whole, of course, net profits are likely to rise around 4%. Let's talk about the factors here. Of course, there will be the benefit of IBM products. There will be a lot of synergies. We are watching out for the kind of client onboarding that comes through, as well as the cross-selling that happens and the kind of advantages that comes along with, considering IBM products are now fully on the books. And moving on, of course, there could be a small decline in margins on account of residual wage hikes. And of course, cross-currency tailwinds could partially aid margins. We're also expecting operational efficiencies to drive and further counter that fall in margins. A 50 basis points contraction in margins is what we're expecting, but that may not be the case. Let's wait and watch how things pan out. There are a lot of investments which are going into the acquisition. But the guidance is perhaps a little more important right now, because last quarter, they hiked their guidance from 14 to 16%. To now 15 to 17%, and now there is conjecture that the lower end of the guidance could be hiked to as much as 16 to 17%. Of course, by now 3 quarters will be done, so we will clearly have an idea what the company can do in the 4th quarter based on their pipeline already. EBITDA margins, or rather EBIT margins, are expected to remain around 18.5 to 19.5%. And of course, we're likely to see an organic growth of around 7 to 9%. So we'll be watching out for some of these cues as well. But yeah, it's supposed to be a steady quarter for HCL Tech as well.
Yeah, I think the issue that happens with this one, Agam, is that people keep on saying that, oh, even if you're making growth through acquisitions, the organic growth is still lower, and therefore why give it higher multiples? And there is an equal number of people who say, how does it matter how it's happening as long as they are managing the deals well?
Correct.
And the actual top line number is good.
Yeah, earnings per share is what matters to a lot of people, and if your revenue is higher, that means a higher earnings per share. And so we do have a lot of analysts right now who are very bullish on HCL Technologies. It's just so that HCL Tech has not yet moved and caught up with some of its peers in terms of valuation.